Welcome back to Business Week here on ARISE News. I'm joined now by Samson Esemuede, the MD and Chief Investment Officer of Zrosk Investment Manager. He's going to help me review some of our top stories. I feel like we have only really one top story, which has consumed financial analysts and markets around the world, Trump's tariffs. I'm not even sure what question to ask you, but say whatever you need to say on this, but tell us what all this means.
Rolake, I think it was Lenin that said that there are decades when nothing happens, and there are weeks when decades happen, right?
Great one.
The last week I've felt exactly like that. And I have been struggling myself, right? Because basically when you think about it, even with the 10% reciprocal tariff that is in force, that's a significant increase in tariffs globally, right? I think from some of the reports that we've seen, on average, tariffs has been around 3%, so you've gone from 3% to 10%. And then the tariff between the Chinese and the US is basically tantamount to a trade freeze.
It
is. Right? So let's put this in context. If you're talking about a 145% increase in effective tariff, and let's assume that average tariff pre-increase was 10%, that is almost a 14-fold increase in your tariff import bill. Right? And I think there's a misunderstanding on who pays this tariff, right? Because ultimately the importer pays the tariff. So do Americans really understand that their import bills
is about on the receiving end?
They're on the receiving end of this, at least in the short run. Obviously, there are implications for China as well. But I've really struggled, Rolake, and this is something that I've been very challenged with, because in my mind, the last 30 decades have been the decade of America. Right. When I started my career in 2007, 2008, on average, the European economy and the American economy were roughly the same size, around 15 trillion. Europe, for all intent and purposes, haven't grown, right? And American economy has pulled up over 70% larger. Income per capita have grown. They've dominated in technology. So it looks like America has a redistribution problem that is interpreting as a trade problem. Right? And that's what fundamentally I am concerned about. And then the second point is there seems to be a lot of focus in America on the trades in goods. Why America runs a deficit relative to the world on goods, it runs a surplus on services. And the scale of the surplus is even larger than what is in the reported accounts, because a lot of technology dominant services that the American companies render to the rest of the world, the cash flow that comes from those services gets offshored. So that money doesn't get brought back. So when you actually adjust for money that is sitting in places like Ireland, which are headquarters for companies like Google in Europe, this trade service, there's basically no trade and services deficit between America and Europe, for example. So, and then the final part is, on the balance of payments, the other side of what I call your trade account is what I call your capital account. America is able to afford the things that it's able to afford, largely because the cash flow that comes from the trade surplus that the rest of the world runs against it gets reinvested into American assets. Which is why, at the moment, what you're experiencing is what I call a correlation one outcome, which is basically get out of every asset in the US that you possibly can. I've traded EM all my life. I only see this sort of price action in emerging markets. This is basically the market. I never thought I would see this happen, right? This is basically the market treating the almighty United States of America like it's an emerging market.
And it's interesting. There's three things I want to ask you on the back of some very detailed analysis you've given there. First of all, the impact on the US dollar. We've seen the US dollar weakening against some key currencies in the past week. Secondly, the theory that this is just about political leverage for other issues. And if so, why such seemingly erraticness? And then the third part of it is really around the impact on the American economy domestically, the risk of a recession, rising treasury yields on U.S. government securities, all of those issues. How are you reading all of those things? Is this just really a political tool? It has such huge consequences if Trump is trying to get people to come to the negotiating table.
I mean, I can't say what Trump is thinking. And some people say that there's 3D chess, 4D chess that is involved in reordering the global trade system. I don't see that kind of strategic intent, if I'm honest, right? So I just take them by face value in terms of what they say and what they want. In terms of your questions around the US dollar, right? Some of the heuristics that you learn in global finance is that when there is risk off, the dollar strengthens, right? In the global financial crisis, during the COVID pandemic, outside of a few weeks where you had...
Because people see it as a safe...
They see it as a safe haven. There are a couple of things that have happened. Obviously, America in the last 3 decades have been a huge destination country for trade. Almost every asset manager in Europe, in Canada, even Nigerian individuals have exposure to US assets, right? And now what you are seeing is what I call the great unwind, right? Because people are now questioning the reliability of the US financial system. And this is, I don't know how, this is seismic, right? And what we are now seeing is that in a world where there is risk off, right, while the dollar typically strengthens, the dollar is weakening. Right? And that is a very, very interesting counter trend that is against any heuristics that you may learn to help your decision making when you trade.
It's interesting because clearly investors, with this sell-off, investors will be demanding more returns to hold American government.
So this is why I say we are now thinking like an emerging market. And to your point on the risk of recession, right? I don't have a crystal ball, and frankly, anybody who say they do, the rules have been upended, so you have to go back to first principle. But I'll say a few things. One is if you are a U.S. individual who works for the government or has a job, right, you are not spending any money under this current environment. You can't remodel your house if you wanted to. Is this the time to be buying a new car? So my expectation is that you're going to see a reduction in aggregate demand from the individual side. On the business side, is this the right time to make new business decisions? Maybe in the short run, you might see significant levels of inventory build, right, which might be in the numbers pre the enforcement of the tariff. But once that inventory gets worked out, I think you're going to see an impact on GDP growth. So while in the past I used to think that what we will see with the Trump administration is a relative slowdown in US growth relative to the world, I think the risk now is that the US goes into a recession and basically takes the rest of the world with it.
I mean, there's all sorts of theories flying out there, Samson, great analysis. I've even heard that this is part of an attempt to bring down the government's borrowing costs. But I mean, this is like the means to an end.
They haven't been very clever around that, right?
Because if you look at, had the opposite effect.
So 10-year yields have gapped and 30-year yields have gapped. Like, I think the move in the 3-day sequential move last week on the 30-year yields is probably the worst we've seen in like 50 years. Right? So these are significant increase in borrowing costs, and I suspect that was why Trump blinked, right, and had to to instigate the pause, because I don't think he cares that much about the bond market. But given the size of the fiscal deficit, I mean, the US is running about a 7% fiscal deficit, and this is a problem because once you go into a recession, the fiscal stabilizers kick in. On average, the cost of fiscal stabilizing during recessions add anywhere between 3 to 5 percentage points on GDP, on fiscal deficits. Now, if you are struggling to fund 7% fiscal deficit and the cost of that is going up, when you go into a recession, where would you find this fiscal space for the remaining
Very
balance?
interesting. I know we're going to have a deeper dive when I get my other guest, Nnamdi, to come on at 10:30. But quickly, I wanted to talk very broadly about this, the U.S. slamming the import restrictions that Nigeria has. Should we take that really seriously?
So it's performative, right? I mean, let's look at the numbers, right? So we export around 5.5 billion naira, 5.5 trillion naira to the U.S. The trade deficit, we run a trade surplus. If you look at the 2024 numbers, we run a trade surplus of just under $1 billion relative to the US. But 88% of that is crude. And I think crude is exempted from the tariff. So when you see that of the 5.5 trillion of exports we do to the US, only about 12 to 13% of that is tariffable. That's about 642 billion of goods that is tariffable. So the first round effect of that tariff hike on Nigeria is about 90 billion naira. 90 billion for an economy that is over 150 trillion is a nothing done, quite frankly. When you look at the size of our deficit, it's 1 billion or slightly under 1 billion. The goods, the trade deficit that the US is talking about, right, is 1.2, 1.1, 1.2 trillion. Honestly, I can't even understand what Nigeria was doing in the tweets from the U.S. Trade Office. We are a complete nothing done. If you completely eliminate the trade with Nigeria, Trump would not even notice. Right. So I think it's very performative, and it really points, in my opinion, it points to the lack of strategic thinking, I think, around the decision making with regards to the tariffs.
Yeah, interesting. Let's hope that the government weighs in on a very high level and actually sees this as an opportunity to re-engineer its trade partnership and its trade relations with the rest of the world. But we need to go for a break now. We'll be delving deeper into this discussion when Nnamdi Nwizu, CEO of Comercio Partners Trading, comes in. Stay with us. Welcome back to Business Week here on ARISE News. Now, global markets are reeling. A fresh wave of tariffs, Trump's signature reciprocal retaliation, has triggered everything from tumbling stock indices to oil sliding to its lowest in 4 years, and China's counterpunch, a jaw-dropping 125% tariff on U.S. goods. Meanwhile, U.S. Treasuries wobble, investor confidence falters, and bond yields soar, dragging financial systems into murky waters. Despite some market recovery towards the tail end of this past week, what does this global trade upheaval mean for emerging and frontier markets like Nigeria? From capital flows and currency pressures to the price of our beloved jollof rice, the ripple effects are anything but abstract. So today, our two sharp financial minds in the studio who understand the chessboard of global markets better than most. Nnamdi Nwizu is co-managing partner at Comercio Partners, a maestro of bonds and fixed income strategy, and he recently penned a piece asking if Nigeria is prepared for the financial fallout of Trump's tariffs. Samson Esemuede, who was with me earlier on, is CIO of Zrosk Investment Management, and he argues that Nigeria doesn't actually benefit from high oil prices and says our sweet spot may lie in a lukewarm $60 to $70 a barrel. Well, let's get into these premises discussion. Great to have you both on. Nnamdi, great to see you after such a while. So I guess the first thing is to ask you what all this means for frontier markets. The Bank of England has said this is pretty much catastrophic for global markets. What's your take?
Well, I mean, from perspective of a trader, it's been pretty crazy over the last couple of weeks. Even if you look at VIX, which is the volatility index, I mean, hit 60 over the last, I think, 9-day forward curve. Basically shows that we've had huge volatility in the markets over the last couple of weeks since we started the whole tariff hullabaloo. If we were to look at what has happened, look at how oil prices have dropped, went as low as about 58, then came back up a little bit. If you look at what's happening with how prices have moved, look at how NASDAQ has jumped, and also crashed back down. All it takes right now is a tweet from the president, and ironically, that tweet that said it's a good time to buy, and then a few hours later, the tariff suspended. It just shows how fickle market can be and how we've seen market move, with huge swings all across. Even if you look at Eurobond market, we've seen huge swings, and today prices are up. The next day, prices start to crash again. So, I mean, definitely there's a big risk as various investors start to de-risk from frontier markets and emerging markets, right? You start to see yields go up locally. You start to see currencies come under pressure. We saw that with Nigeria, where we've gone from about 1,005 to about 1,630 or thereabout over the last couple of weeks. Central bank has had to intervene, quite a bit in the FX market to try and keep things a bit stable. From what I hear, maybe they sold about $850 million over the last couple of weeks, and estimate about 1.5 billion has more or less gone out from the foreign investors so far. Might have been a bit more, but there's been a bit of illiquidity in OMO bills. So there's FX trading, the two-way system working pretty well, but nobody wants to buy the OMO bills that they're holding, right? So it's a bit difficult to see them moving out and really exiting. So you might have had more people exit.
It's interesting because, we were talking earlier, you're talking about de-risking from frontier and emerging markets. So where's the flight to? What safety? Is it the US dollar or US treasuries or what is it?
Actually saying, people are saying that they're going to Europe. People are actually moving from the US, yes. European market has performed, pretty well, not like what we've seen in the US. there was quite a bit of flight safety in the US. They saw treasury yields drop right initially, but speculations around margin calls for people for various hedge funds based on the fact that they've had quite a bit of downwards move in US equities, and they had to find liquidity. So it had to sell gold, had to sell US treasuries, which sort of moved it back up. And also some speculation around, read an article where they said Canada and a few other countries sort of hinted to the US that if they continue with the tariffs, they'll start to sell US treasuries.
Interesting.
Right? And that might also have contributed to what we've seen, because we saw yields move from about 4.5 to 4.8 or so over a short period. Huge. I mean, that's a huge move for the US treasuries.
I mean, you said a lot in there. And so I want to even ask you about, let's look at commodities, right? We've talked about some of the securities and other asset classes, but commodities, the oil price. Let's look at Nigeria, for instance. Your view is that actually lower oil prices are not such a bad thing for the country.
Well, I would caveat that, but before
you want to respond?
Before I get two things. One is, when you subject complex systems to shocks, it's very difficult to be able to wrap your head around the secondary effects of that shock.
Okay.
Right? And so anything I said has to be taken from that perspective, because a lot of things are currently being upended. Right? On the impact of the oil price, it makes sense, right? Because the market is pricing in a recession in the US, and I think a recession in the US probably drags the rest of the world with it. And the oil market has been in a very tight supply-demand balance. So if demand shrinks, I think the impact on the price. And the way oil pricing is determined through the marginal cost of supply. Right? So if demand disappears at the point where the marginal cost of supply is, there is no downside protection unless OPEC steps in to basically take supply out of the market. So that impact has been significant. To my point on impact of oil price on Nigeria economic structure over the last 18 to 24 months has been shifting. And what do I mean by that? The CBN, to its credit, has been able to achieve some level of FX stability without significant remittance from the NNPC.
Okay.
Right? And it's really been anchored around FPI and getting remittances flows, right? That is basically what has driven our FX stability,
revenues
not revenues from oil price. And why is that, right? Obviously, there were lost volumes due to the oil theft issue. There was also the massive subsidy that was the massive drag. So the NNPC remittance to the fiscus and by extension the reserve wasn't there.
So what you're saying, we've somehow learned to adjust.
So the reason why I made the statement, because I wanted to set the context so that you understand what I mean.
Sure.
So, and now we've removed the subsidy, which means that our inflationary pass-through, right, has increased. The commodity link to our inflationary pass-through have increased. What does that mean? It means that for any movement up or down in the oil price, the man on the street feels it and it has an impact on the inflation, because what tends to happen is that Dangote, who is the marginal price setter in the downstream sector, adjusts his prices.
Right.
So when oil price goes up, what you might get is increase in fiscal revenues, but the counter side of that argument is rising in inflation that complicates monetary making decisions, right? And when oil price goes down, you lose the fiscal revenue, but as long as the currency stays stable, but you benefit from reduction in inflation, which is why my base case was actually Nigeria, as a result of relinking its fiscal pipe plumbing back to the fiscal and to the reserve, doesn't really need a very high oil price to record significant level of fiscal revenue. Okay, well, that's good news,
especially when you think about the budget benchmark of $75 a barrel, and we're starting to have a few shocks on the production side. But in terms of a longer-term downward trend in the oil price, because I think your theory potentially works if we stay in a particular range. We're hearing doomsday scenarios of going down to $50 a barrel.
I mean, very low oil price is problematic for Nigeria, right? Because think about it. I would say two things. One is, I'm actually glad that the Naira weakened over the last couple of weeks, because we are now operating in a different regime. It's not a peg. When you look at the performance of the Naira relative to other risk assets, we've actually outperformed, right? Naira has weakened around 7 to 8% since this crisis started, right? And if you look at NASDAQ, you look at the S&P, you look at Eurobond pricing, we've actually performed in line or actually better on average, right? And that adjustment in the price basically also, I know the CBN has been intervening to help smooth out the volatility.
Yeah.
They are market participants. They have significant size, so they can influence pricing. But the fact that the Naira wasn't pegged and they tried to defend it at that peg, in my opinion, is positive, right? So that's one point. The second point I wanted to make, of course, low oil price is terrible for Nigeria because our medium-term strategy around FX stability was receipts that is going to come from what I call the oil terms of trade.
Yeah.
And what do I mean by that is I didn't think pricing was going to go up significantly, but I think with the investments in the downstream sector and the change in asset ownership into domestic hands, there was an increase in recounts. Recounts are up. I saw like probability of improving volumes, right? And then that volume had a higher impulse, largely because you didn't have the subsidy system and the pass-through into reserves and revenue was there. So the way I saw FX sequencing was short-term FPI remittances flow, medium-term oil revenue related, and in the long term, the success of this strategy is how they recycle those revenue into supporting non-oil
Absolutely,
exports.
that makes total sense. Essentially, what I'm reading from this, Samson, is that some of the reforms Nigeria has actually embarked on in the last year have helped us to some extent weather, at least will help us in some extent weather some of the short-term impact of all this global trade tensions. Can we come back to bonds? I want to talk a bit about U.S. Treasury yields. We're seeing a spike shortly post-tariffs and then calming. What does that volatility in bond markets actually mean for frontier markets in terms of valuations and capital flows?
Well, it's always a bit of a conundrum. So when you see U.S. yields move up, people tend to try and reprice, looking at credit spreads, right?
Yeah.
So you tend to see Eurobond yields, for instance, also move up. I mean, if you look at the carry trade, you're looking at the spread.
Yeah.
If the UST 10-year has gone from, say, 4.4 to 4.8, you would expect that Eurobond yield would also move, and they don't move by 40 basis points. Maybe you have an 80 or 100 basis point movement. Flip side also is that when you have USTs drop sharply, and they say the flight to safety, Eurobond yields also move up. So sometimes it depends on what is happening at that point in time.
Yeah.
But one thing is certain: we have seen Eurobond yields move up pretty aggressively. So
are we going to see more appetite?
Well, so the good thing is when the dust settles, because it will eventually settle, it will make the Eurobonds a lot more attractive, right? So we've seen Angola move from, say, about 10%, 11% to as high as about 14%. We've seen Nigeria Eurobond yields go from 8-9% to 12% levels. So we've seen them move about 200-300 basis points. Meanwhile, UST has gone up about 40-50 basis points. So I think it's a bit of flight to safety de-risking, but at the same time, we've seen the UST also move up, which is also a bit unusual because ideally it should be coming down. So so
nothing makes sense in this market, as you were saying.
Every time, new time, just the same way the COVID period didn't make sense, right? A lot of things happen. So you also have new things. People are looking at, economic scenarios, and new trends are emerging, and I'm sure you're going to see people come up with new thesis around a lot of these things. So definitely not good for frontier markets to see the UST moving up, and like I said, we've seen it. And then even locally, it's still the same thing. If USTs are more attractive, then there's no incentive for them to stay in the local markets, right? And JP Morgan came up with an article initially saying neutral, and now they seem to be saying sell and exit Nigeria.
That's interesting. They say sell. I thought they were bringing back the investment
those are tactical trades, right? So it's basically the trading desk that came up with it, because I read the report.
As opposed to
and in the report they caveated that they are in support of the reform. And
they better be. They're trying to bring back shop to Nigeria.
And also research people always have caveats. You always have to put the caveats.
Yeah, I think tactically it makes sense to close when there is significant level of risk off when
you've made profit also.
Exactly.
So from a strategy perspective, you're managing portfolios for investors. From a strategy perspective, I'm even trying to figure out how you pitch now. So we've seen, for instance, in the US, tech stocks, everything has taken a hit. If you're an African investor, are you rebalancing away from US equities and looking elsewhere on the equities market?
So, I think there's the mega trade that will probably take almost decades to unwind, right? Which is the flow of funds from the US, out of the US. Remember, most European, Canadian, even Nigerian asset managers have significant level of exposure to either US fixed income or US equities. The US, and this is one of the reasons I've been very confused about Trump, because the last 3 decades have been, since the GFC, have been the decade of US exceptionalism, right? And so he's unwinding that. So from that perspective, I mean, since COVID period, the US equity market alone has basically attracted about $9 trillion of inflows, right? Some of those flows will unwind. And we obviously go to the safer places like Europe that I think is now in the process of engineering what I call a fiscal impulse, right? Because one of the reasons why Europe has sort of been a forgotten continent is frankly the fiscal hawks. They ran flat revenue budgets while the US was running 6-7% budget deficits. This budget deficit basically acts as fuel that catalyzes your economy. And when you travel around Europe, you see that the infrastructure is decrepit.
I also feel like Europe has been stifling innovation, their regulations, there are just so many things.
So I'm hoping that this is a moment of shock for them because they've depended on the US umbrella for so long, right? Both from a security perspective and from a technology perspective. That umbrella is no longer reliable, which is why the Germans came out in March, right? And basically said they were going to be spending €1 trillion over the next 10 years. Right? And then there were some really unconstrained spending on defense, right? So we are now going from a situation where Germany, which is basically the largest European market, is moving from the debt brake. The debt brake basically didn't allow Germany to run more than 35 basis points of budget deficits. That's 35% of 1%.
Yeah,
right?
Part of the monetary union convergence criteria.
But now, right, from what Merckx was saying, the soon-to-be chancellor, Germany could be running anywhere between 3 to 4% deficit over the next 10 years.
Well, hold that thought. I want to talk about Nigeria's stock markets.
Sure.
And how decoupled are we really from international shocks? If we look at what has happened in the last few months, we've seen record earnings, financial institutions, they still hold the biggest share of market capitalization. Does that factor, amongst other things, means that the NGX is still relatively decoupled, or are we still going to be at the, beckoning of international capital dynamics? What's your take on the NGX?
I would say over the last few years, we've not seen a lot of foreign investors' participation in the US and the Nigerian equities market. Same thing with the fixed income markets until the last couple of years where interest started to peak in. In fact, over the last year, when central banks started to raise rates, so some interest has started trickling in from what we heard. Started looking at some blue chip names, started looking at things like agric sector, but not with the kind of sizes that we used to have prior to, say, 2008, times or so, where they had a huge presence in here. So I think to a large extent, the local equities market is decoupled from
it's local.
So Nigerian equity market, I think to a large extent is decoupled. You're not seeing the kind of volatility. What we've seen in the Eurobond market, for instance, we've not seen it. What we've seen in the local bonds market, we've not seen it happen in the Nigerian equities market. And we also have to agree that the liquidity in our market not so great. So the kind of sizes you would see foreign investors coming in won't be as much as you would see in the other markets where you have huge volumes going through on a daily basis.
No. I on the equity side, I do agree. Right. I was looking at some data when I was launching one of my funds, and in 2014, the total stock of foreign portfolio holdings in Nigerian equity market was about 14 billion. As at the time when I was launching the fund, which was September last year, that number was about 2 billion. Right. So there's been almost a 90% reduction in foreign participation in the local market, which is why, like the last week, I've been actually impressed, but maybe I might say that too early because Nigeria tends to have a delayed reaction. So you're always very nervous around.
You still don't know what's
calling
Yeah.
victory, right? The market has been a lot more resilient than I thought it would be, right? I think that the NGX is still up this year, despite the carnage that has happened in the rest of the world. That tells you that the level of offshore portfolio outflows is not significant, and earnings have been very, very strong. I don't think tariff impact on earnings is going to be significant, right? Because I think first order effect on tariffs, based on our calculation, is about 90 billion naira. That's a drop in the ocean when you compare it to the size of the economy. Earnings are strong. The only real risk, right, for me is one of my views around the equity market was basically stabilization of the macroeconomic situation and the pass-through impact on FX and the bond yields. And I thought that given the work that the CBN has done, Nigeria will be in a disinflationary trend this year, which will affect cost of capital across the board. And if that happens, equities, fixed income, assets would do very, very well.
Absolutely.
That is now being threatened because if oil price continues to come down and we go into a recession, I think that there is the CBN has done a lot of work in terms of its ability to defend, right? Net reserves is now about 23 billion. So that's about a 7-fold increase in net reserves, right? So gross reserves have gone up from 32 billion to 40 billion, but net reserves have gone up 7 times. So when you look at the scale of intervention, I think last month they intervened about 700 million. So the CBN can continue to intervene at this pace for another 30 months before it runs out of cash.
Okay, that's not a bad prognosis. Samson, I want to ask you, in terms of the strategy for Nigeria, let's take it at 2 levels, sort of macro strategy for the country, and then from an investor perspective, over the next 6-12 months, how should investors be positioning in this market?
I would say, so first of all, a lot will depend on what happens with the currency over the next 6 months, right?
Okay.
If we are able to keep it in range of 1,005 to about 1,008, then it shows that truly we're resilient, right? And that would give investors a lot more confidence to come back in. So you've had, first of all, if you look at the foreign investors, first of all, you've had a depreciation of the currency. You've had yields start to move back up, making it more attractive for them to come back in again.
Yeah.
Once again, the dust starts to settle, you most time start to see new inflows and people coming back in for the carry trade. On the local, if you're looking at local investors or Nigerian investors, this would be a good time for those who are liquid to come in and say, look, we want to get a bit of fixed income. Right? I mean, so now bond yields, 22.
FGN bonds.
Yeah, FGN bond yields,
NTBs.
22, 23%.
Yeah.
10 years, that means, well, you've gotten 2 times your money back and you still have your principal. That's fantastic. For those who want to structure, how many people would typically get 22, 20% returns on their funds?
Yeah.
So if you're a passive investor, great. If you're a fund manager, not actually a bad deal for you, right? Especially when you factor in the tax element, which you still get on bonds versus treasury bills. So that 22% effectively might take you to what, about 28% when you factor in tax?
And hopefully, if inflation stays on the downward trajectory or relatively muted, then
that is the risk, right? I mean, let's not downplay the impact of what has happened in the US, right? I think it complicates policy decision making.
It does.
I think there is a chance, right, that the CBN might have to keep liquidity much tighter than we thought they would this year, right? And by inflation, it also means that yields might have to stay higher for longer to be able to combat this, right? And that then threatens and challenges the recovery trade, right? So we were thinking that Nigeria will be in a firm recovery territory by the second half of this year. We might have to push that out.
You, specifically Zrosk Investment Management. Comercio, is that your outlook as well?
No, well, I mean, a lot has changed. For a lot of people, everybody was trying to read predictions and start to look at new things that was happening.
Yeah.
People, there's a lot of talk of recession.
Yeah.
I personally don't think global recession. I personally don't think that happens. Because why?
Yeah.
Because Donald Trump would not want it on record that he caused a global recession. So having a meeting with my guys yesterday, and people said, we've had recessions in the US, but we've never had one caused by the US government. It's always been maybe subprime mortgage, COVID, financial crisis. But for it to be caused by the US government itself.
Nixon, 1971.
Okay, maybe that's what I'm saying.
That's an interesting perspective.
But for them to actually be the ones to cause that recession by pushing up tariffs, and that's why I believe you've seen sort of a pause in tariffs. Because they're also realizing how much is affecting the US and economy and how it would look on them. So I almost think that this 90-day tariff pause almost becomes
a permanent pause. Well, this may lend credence. We need to wrap up, but this may lend credence to the theory that there's an underlying fundamental political, geopolitical goal behind the tariffs.
Yeah.
And hopefully, we get to the end of that goal before things spiral completely out of control. But Samson, I know you want to say more. Run out of time.
It's
1
okay.
second.
Yeah. All I just want to say is that I think it's a complex system. We don't know what is going to happen, right? Once you shock a system like this, if you look at the survey data, Michigan Consumer Survey came up. It's already singing recession.
Okay.
It's only a matter of time before sentiment goes into hard data.
Thank you so much, guys. This has been such a fascinating discussion. I've been speaking to Samson Esemuede, CIO of Zrosk Investment Management and co-managing partner at Comercio, Nnamdi Nwizu. Great discussion. Well, that's all we have time for on Business Week. If you want to follow the discussions around global financial markets, let's continue the conversation on X. I'm Rolake Akinkungbe-Filani. Do have a lovely rest of the weekend.